Hey guys, in this module, we're going to cover the 3 ways to make money in the stock market. Now, the first way, very simple, is going long a stock. What is going long a stock? It basically means I'm buying the stock. So you buy a stock, you expect it to go higher, and you sell it at a higher price and you make money. That's the easiest way to make money, right? Again, if you buy it and it goes down, you're losing money, but that's going long. Now, there's another way to make money. And this way is the one that's less common. It's going short. And what going short means, it means that you're betting that the stock is going to go down. So you want to make money if the stock actually drops in value. Okay? A lot of people go short, but not a lot of people know about it. So you might ask yourself, how do I sell a stock that I don't originally own? Right? How can I bet that a stock is going to go down? Because by betting it's going to go down, what you're actually doing is you're selling it at a high price. And when it goes to a lower price, you buy it back at that lower price. How can you sell something you don't own? Well, by borrowing it. So the way it works is you actually have to borrow those stocks. Now, who do you borrow it from? You borrow it from your broker. So very simple. All you have to do is, if you're looking at a stock and it's trading at $10 and you think this stock is going to go down to $8, so you want to sell it at 10, and when it goes back to 8, you want to buy it back at 8. How would you do that? You call your broker, tell him, hey, I want shares of this company ABC. Can you lend me some? Now, your broker has a lot of other clients. Your broker is going to look around. He's going to see that, some of my clients have shares in this company. I'm going to take it from them. I'm going to give it to you. Now, I'm not going to tell them that I took it from them. So they're not going to know anything happened, right? They're sleeping. They don't know. They think their shares are still in their account, but they're not. I'll give you the shares. Now, you go out, you go on the market, you sell those shares for $10. Now, you got $10 in your account. As predicted, the next day or the next week, the price falls down to 8. Now, you still have $10 in your account. You can buy back the shares at $8. So you buy them back at $8. You still have $2 in your account. And you have the shares. Now you can call your broker, tell him, hey, here's the shares. I'm giving them back to you. Your broker gives them back to its original owner, puts them back in the account. The original owner never knew they were gone, so has no idea what just happened. And you're left with $2 in your pocket that you made out of thin air. Because you sold something that you didn't own, and when you bought it back at a lower price and gave it back, you made that difference in price. So you can short stocks. You need a margin account to short stocks. You can't short them in any accounts. We're going to cover margin accounts in another module. So you can short stocks when you expect the stock to go down. Now there's dangers in shorting stocks. And it's only because of this. Because when you're shorting a stock, how much money can you make? What's the maximum amount of money you can make? Is the price that you shorted at. So if you shorted a stock at $10 and it drops down to $0, how much money did you make? You made $10. Now, how much money could you lose? Well, if you short a stock at $10 and the stock goes down, let's say it goes up to $40. What happens? You're losing money. You gotta give back that stock. You're not gonna hold it an infinite amount of time. You're gonna have to give it back to its original owners. So if you buy it back at $40, you actually lost $4, right? So if you buy it back at $14 and then give the shares back to the broker gives it back to its owner, you had to buy it at a higher price than you sold it at. So you lost $4. Now the problem with this is what? Is that the price can go up not only to 14, it can go up to 20, 100, 200, it could go up to infinity. So the amount of money that you can lose is infinite, but the amount of money that you can make is limited. When you're going long, it's the opposite. The amount of money that you can make, that you can lose is limited, but the amount of money that you can make is infinite. So you really want to watch out for shorting stocks. And another issue is that in the long run, there's a natural drift of stocks going up. So stocks tend to go up with a little bit more probability than they are likely to go down. So it is something that's riskier. The very good thing about shorting stocks is when stocks go down, they go down extremely fast. But when they go up slowly. So a lot of traders, and this is one of my favorite things to do, is to pick stocks that I feel are going to break down and short them very aggressively because I can make a lot of money in a short period of time. But I never keep my shorts for a long amount of time because it's not a good thing to do in the long run. You just want to short for short amount of times because if there is something that's going down, it's going to happen quickly and then it might recover. Now, this is going long, this is going short. These are the two ways that you can make money, but now I add the third way. And that way of making money is called being flat. Now, what is being flat? Being flat means having no positions. A lot of new traders come in and they think they always have to be in the market. They always have to have a position, be long, be short, to be making money. But you can actually be making money, but by not being in a position. Because if you're not in a good position, you might lose money. So by not losing money, you're actually making money. So being flat, having no position, you're avoiding the risk of losing money. So you're actually making money by not losing it. So very important, if there's no good opportunity, if you don't have something solid, if you don't know, if you didn't do your research and you're just busy somewhere else, you don't need to trade. You can be flat. You can have no positions. And that is going to be a way for you to make money. Every good trader, if he's busy, if he's not focused, don't trade. Be flat. That's going to be a good position to be in. So these are the three types. These are the three ways that you can follow to make money. And that's going to conclude this module. And I'll see you guys in the next one.